Hey traders, Jason here from Leavitt Brothers. In this video I'm going to do an update of my State of the Market series. It's easy to be drawn in all the headlines and news out there, especially in today's political climate. So every once in a while it's nice to stand back, look at the charts, see what's going on, and just completely ignore the short-term noise. Alright, let's get to it. So here's the S&P monthly chart. It is as bullish as you can possibly be. As long as the index, in my eyes, as long as the index stays above its 10-month moving average, the trend will be up. Okay, and right now, with the market being over 2,800, in the 10-month being down at 2,500, mid-25s, it's got a nice buffer to work with. If you would have just used this simple indicator, just I'm long if it's above the 10-month, I'm either out or short if it's below the 10-month. Obviously, you would have nailed the bulk of all the trends going back several years. This chart looks fantastic. There is no reason to be anything but long, especially if you're a longer intermediate term trader. Zooming in a little bit, here's the weekly. It looks equally bullish. The 50-week moving average has been very important over the years. It supported the market, supported the index back in 2014, 15. A little bit of resistance here in 15. Got above the moving average, did a little double touch here. You can see the arrows. Moved up to a new high, came down, did one more touch, and then it's been off to the races ever since the election. The market can't be stronger than it is right now. And just like with the monthly version, as long as the index stays above this moving average, I'm going to consider the trend to be up, and you should be long. Yeah, there's going to be some wiggle room here and there, and there's going to be some little pullbacks. But if you're a long or intermediate term trader, this is my magic line. This is like the line in the sand. As long as the index is above it, my bias will be to the upside. And obviously with the index up at 2,800 and the indicator down at 2,500, you got a pretty big buffer to work with. Zooming in one more time, here's the S&P daily. You can see the slope of the trend has changed, has notched up several times over the last year. You can see in May it was kind of nice and gentle, notched up over the in the fall months. Then in November it notched up again, and then in January it almost went vertical. It wasn't until yesterday that the trend line was actually broken. So who knows? Maybe we have some near-term weakness to allow to kind of regather its strength. But markets don't get better than this. You can say what you want, you can guess what the market should be doing, but this is what the market is doing, and obviously it is moving up. So you'd be wise to just stay long and ride it for what it's worth. All right, now let's look at some of the indicators. All right, so here's the S&P 500 versus the 10-day moving average of the advanced decline line at the NYSE. This indicator tends to roll up and down perfectly fine as the market, rallies up and then rests and rallies up and rests, and it's perfectly normal for it to kind of go up and down. When you get a divergence, it tells you that there's probably going to be a little bit of weakness coming. It's not a very sensitive indicator, so it doesn't happen immediately. But when a divergence plays out over the course of a couple of weeks, you tend to get a little bit of a pullback, and that's what's happening right now. We got a divergence starting basically in early January. AD lines continued to drift lower, and now it just went below zero. So even though the market's done really, really well, over the last 2 weeks, on average, decliners have beaten advancers. This is a shorter term indication. Okay, it doesn't tell you anything about the long term. It just tells you whether the market's fully supported or maybe a little bit under pressure. Right now, it tells us we're a little bit under pressure, and so we can expect a little bit more weakness, but we'll see what happens. If it hangs out down here, kind of like in August, where it kind of stayed really low, then you can expect like a slow period that lasts a couple weeks. But if it bounces pretty quickly and gets back above zero, it'll be back to business as usual. Okay, here is a cumulative version of the chart that I just showed you. Obviously, it's trending up. It's above its 50-week moving average. As long as that remains the case, the market's in good shape on an intermediate term basis. Anything goes day to day, but when you're looking out a month, 2 months, 3 months, as long as this curve is going up, the market's going to be well supported. It's not until this indicator rolls over and starts to drift down and maybe takes out its 50-week moving average that the longer term traders should really be worried. So right now the market's well supported. All right, so here's the S&P 500 versus the AD volume line, the 10-day, the AD volume line. The AD line favors the small caps, okay, because Apple is included, is counted exactly the same as some small company. This chart, the 80 volume line, favors the big caps that trade a lot of volume. Okay, so you can have one big volume stock that is equivalent to 50 or 100 small stocks that don't trade much volume. Okay, the indication here is the same. Okay, we had a divergence in January. It just fell below zero. That tells us that we might have some near-term weakness, but it's a shorter-term indicator that's not extremely sensitive, but it's still shorter term. So it just kind of tells you in the near term you might want to look out for a little bit of weakness, but overall it doesn't tell us anything. To get an overall picture, you smooth it out with a cumulative version of the chart, and like the cumulative version of the AD line, what we're looking for is a divergence between price and the indicator. We're looking for it to go below the moving average, and right now nothing's happening. Okay, since early 2016, it's been up, up, up. A little pause here at the beginning of 2017, but it's just been going. It's got a one-track mind right now. It's not until this indicator actually drifts lower for several months that the longer-term bulls should be worried. So right now, this is telling us the market's in great shape. Here's the S&P 500 versus the NYSE new highs. Got a couple spikes here in January, which is good. The 10-day of the new highs, which is this blue line, moved to a 52-week high. So it's all good. It's all supportive. Any thought that, hey, the market's making new highs, but individual stocks are not making new highs, you could dash those thoughts, because we're actually getting a lot of new highs among individual stocks. The market's up, individual stocks are up, everything looks good. We did get a plunge here, to be expected when the market drops. But as long as this indicator doesn't just hang out down here at a low level, the market's going to be supported. Okay. What I would worry about is if the market made new highs, but new highs among individual stocks decline. But that's just not the case right now. Okay. Here's S&P 500 versus new lows. We got a big spike in new lows, which is kind of curious because you expect a spike after the market moves lower for a period of time, like in 2016, where the market moved lower for like 3 months. Then we got a big spike in new lows. Here we got a spike off the high, which is kind of weird. You don't typically get that. And the 10-day of the new lows has been trending up for a couple weeks. So it does seem like some pressure is building here. Okay, a rising tide isn't completely raising all ships, because obviously there's some stocks making new lows here. Okay, it's something to keep keep an eye on. Here is a chart that's the high-low differential, so it's new highs minus new lows. Obviously, with new highs coming down and new lows spiking, we got a spike down here. This is the lowest spike in a couple of years. A single spike, not something to be worried about, but if you get an extended period of time, like say here in August, where this indicator stays below zero, then you're going to get some market weakness. Okay, a single spike, not too worried. A healthy market, you tend to get some up and down movement above zero. But if you get extended prints below zero, that usually spells trouble in the near term. Okay, so we'll have to watch this one. Okay, if I take the last curve and do a cumulative version to kind of smooth it out, this is what it looks like. The mark, as long as it's trending up and trending up above its 50-day moving average, the market will be in good shape. It's not really until this indicator rolls over that the longer term and intermediate term traders should be worried. It happened in let's see here, 2015, where you can see the indicator crossed the 50-day and actually trended down for 2 months while the market was flat, and then the bottom fell out. Okay, so you tend to get this indicator is going to roll over first. Okay, the market's not going to just top and go down. This indicator is going to move lower for a couple months, and then the market's going to top. So right now, I mean, it's at its highest level. It's moving up, moving average moving up. It's not even close to taking out its moving average. So, near term anything can happen, but in the overall, this indicator looks really good. Okay, a couple more charts I'll go through quickly here. This is the S&P 500 versus the percentage of S&P 500 stocks above their 20-day exponential moving average. During a healthy market, the number tends to oscillate above 50. As you can see, these blue boxes I drew, it basically goes from 50% to 80% and just up, down, up, down. That's a healthy market. Okay, if 50 to 80% of S&P stocks are above their 20-week or 20-day moving average, the market's well supported. It's not until this moving average goes below zero and stays there that the market actually runs into trouble. Obviously, it's not happening yet. We're above. We moved off a high. We're at 60%, which is a good number. So this indicator tells us not to worry yet. Okay, if it goes below 50%, fine. If it spends an extended amount of time there, then we'll have to reevaluate the near term. But as of right now, this indicator says things are in good shape. Okay, backing up, same type of chart, except we're going to use the 50-day moving average instead of the 20. The concept is the same. As long as it oscillates at a high level, in this case, like in the mid 50% range on up, the market strength is supported. It's not until this indicator goes below like say 60%, 55%, and stays there that the market runs into trouble. So right now, with a print up in the mid 70s, market's in good shape. Okay, the market's strong, it's healthy, and more than 75% of stocks are above their 50-day moving average. That's a good number. All right, here's the same chart backing up one more time with the 200-day moving average. A lot of institutions use the 200-day, so we want to pay attention to it. Okay, if the market was making new highs, but less and less stocks were above this moving average, then you can consider that some sort of a divergence. It's not happening right now. Okay, as of right now, 80% of S&P stocks are above their 200-day. That's a well-supported market. Okay, so any thought of like, hey, the market's moving up, but stocks are not participating, we can get rid of those thoughts, because this chart's telling us that 80% of stocks are above the 200-day, and that's a well-supported market. Again, anything goes near term, but overall, market's in good shape. Couple more here. S&P 500 down below, bullish percent chart up above at the NYSE. This is the highest print in a while. It just rolled over and went below its moving average. It tells us maybe in the near term there's going to be a little bit of weakness, but the absolute print is still very high and very healthy. So it tells us it's the market's supported. We have a print of 75. 75% of stocks have a buy signal on their point and figure charts. That's really good. Same chart at the NAS, similar situation. We got the highest print we've had in a while. It just rolled over. Maybe we have a little bit of near-term weakness, but overall, unless this thing actually trends down for a month or longer, I wouldn't be worried if I was longer-term oriented. One more chart, S&P 500 versus the 10-day moving average of the put-call ratio. When the put-call curls up from the bottom and moves up, you tend to get some market weakness. Not even some weakness, but at least a pause. Okay, it doesn't happen every time. It does happen most of the time. Okay, so we got a curl up last week. Put call is moving up right now, so it's a little bit more evidence that tells us that perhaps we got a little bit of weakness ahead of us, but certainly doesn't look out further than just a couple weeks or so. All right, so overall, I'd say looking at these charts, I say near term, like maybe we have a little bit more weakness. Okay, the 80 line, the 80 volume line, moving down there below zero. Couple of the charts kind of hinted at like maybe there's a little bit of weakness coming in the near term. But overall, when you stand back, look at the big picture, look at the cumulative version of some of these charts, see how they're still trending up, see how their 50-day moving averages are trending up. They're not even close to rolling over. I think if you're long-term, intermediate-term oriented, the overall market still looks good. It's strong, it's healthy, and any kind of thought that maybe stocks aren't participating, we can do away with those thoughts, because the market's doing well and it's well supported. Okay, come check us out at Leavitt Brothers. We find the best stocks and the best groups. We profile them and bring them to your attention so you can make money. Okay, you still have to do some of the work, but heck, you could start each day and each week with a really good list to work from. One good trade pays for your subscription for the entire year. Come check us out.